Now we've got our trial balance done, but we determined that there are some differences between the amounts in our trial balance that are reported from in our ledger and our actual amounts that we have on hand. Okay? So for all of you guys, look at your ledger for your candy company. Take out your ledger for your candy company. Take out your ledger for your candy company. Look at the balance in your ledger. Okay, look at the balance in your ledger. Then pull out your candy stash in your bag. Your candy stash in your bag. Is the amount that's in your bag the same amount that it says in your ledger? No. Nobody's is, right? Is anybody's the same? No. Your ledger balance and your actual inventory of... Say, okay, Allie didn't eat anything. Give me a piece of your candy, Allie. Because you have to have a difference. I'm sure everybody will help you out. No. Okay. All right. So we need to do what's called an adjustment. Because our balance in our bag, or what we call balance on hand, is different than the balance in our ledger, we have to do an adjustment to bring our ledger up to date with what we've got on hand. Okay? So we call these adjustments changes that are recorded on the worksheet to update the ledger accounts at the end of a fiscal period. It is applying what we call the matching rule. This is an accounting concept that is very, very important. We will work with it extensively second semester. Basically says the matching of expenses with revenue. That when a business, whenever a business reports revenues, we've got to try to match the expenses that are associated with the revenues that were generated. Okay, very important. It is relatively easy to do when we've got a company that is like a Target or a Dick's or a Macy's, where we have like a bag of candy, we have a finite amount of these things that we're selling. We buy them, we record that we bought them. We sell them, we record that we sell them. We do an adjustment for the difference. Much harder when you're manufacturing something like, say, a Boeing 747 aircraft. Okay? That's going to take, maybe months and months or a year to build. What period you report the revenue? Do you just wait until you actually physically deliver that airplane to that company? Well, suppose you deliver 10 aircraft in 1 year, but you don't deliver any aircraft until another whole year later. Doesn't your income look really great for that 1 year and then really terrible for the next year? But you've had all those expenses because now you're going out and you're buying all that stuff that goes into building that airplane, right? But you don't have any revenue associated with it because you're going to wait until the aircraft is actually physically at United Airlines to record any revenue. It doesn't work that way. They have to record revenues in the fiscal period. They have to record expenses that are used to generate that revenue. Think about, too, like when a company builds a road. Very hard to, very easily say, oh, well, how much of the road is built? How much revenue did you earn? Okay? So businesses have to come up with a methodology for recording and reflecting what is the revenue that I earned during a fiscal period, what's the expenses that were used to generate that revenue. And so we use this accounting concept called matching of expenses with revenue to help us to do that. And that's what we're doing when we're going to apply this adjusting entry process to adjust those expenses for that fiscal period that we're operating in. So the worksheet is used to help us plan out those adjustments. And then the information that we do in those adjustments is going to later on be journalized and posted to actually bring the ledger balances up to date. Because just because we do it in the worksheet doesn't mean the actual ledger balance is up to date. Because how can the only way that we can get the ledger up to date is by posting the information that's coming out of the journal. So we have to journalize that adjustment and then we have to post it, which we'll learn about as well. Okay, so let's look at adjusting for our supplies. So just like with your candy, except for Allie, just like your candy went down during the period, we had a balance. The balance that's in your ledger right now is the balance that's going into the trial balance column. Okay? What's going to go into the adjustments column is the difference between what's in your ledger and what you actually have on hand. So, give me a person. Bobby, what's in your ledger? What's in your ledger for your candy?
You want me to just read my numbers?
Yeah, what's your balance?
My balance is 27.
Okay, so Bobby's ledger balance would be in the debit column on his trial balance as 27. What's the amount that you have on hand in your bag?
3.
So he's got 3. He's only got 3 on hand. So the difference between 27 and 3 is how much? 24. That's the amount that we're going to credit or decrease his value of his supplies inventory, his candy inventory or candy supplies balance. Okay? So we're going to do a credit to our supplies because they went down, right? So how do we show that our supplies went down? If it's got a normal balance of a debit,
Credit it.
we're going to credit it to show that that balance has gone down. But now we have to show that we've used it up. And we're going to do that by expensing it. So now, if you notice this line starts as 5 and this one's at 17, this is down at the bottom of our list of accounts. Our supplies expense is going to be what we expense to show that we've used up that much of our supplies during the period. So we're really converting our asset into an expense, if you will, to show that it's used up. So as your assets are used up, you show that they're used up by expensing them. And that's what we're going to do here when we do our adjustment. So if we see, this is just showing the math behind it. Our supplies balance was $1,025. What they actually had on hand was $310. The amount that's used up, the $715, is the amount of our adjusting entry. And this is showing you what the balances are of those T accounts after the adjustments. So we can see our supplies was $1,025. We adjusted by $715 by doing a credit. Our new balance is $310. So we're going to write the debit amount, write the credit amount, and then label the two parts. So you're going to do a label A and A, so that you know later on when you do your journal entries that these are going to be your journal entries. I don't think that Applia, when you do this, I don't think Applia lets you do those A's and A's, if I'm remembering correctly. But just keep that in mind that you would normally label them. Same thing, prepaid insurance, okay? My company buys some insurance. We buy some insurance and the months go by and we've used up insurance. Each month, a little bit of insurance is used up. At the end, we have an unused balance of our insurance at the end of the month of $1,100. So therefore, during that month, we use up $100 of insurance. So we do the adjustment, and we see that after using that up, our new balance is $1,100, and then we label that B. Okay, so we're going to stop there. And we're going to go over to our work together. No, I'm sorry. We've got one thing I've got to finish. Sorry. Okay, so we're going to prove our adjustments column by bringing the information down. So we'll bring our debits down and our credits down, and again, same thing. Our debit balances and our credit balances should equal each other, and then we would double rule. So you'll rule the single line, you'll total them, and then you'll do the double line after they equal. Okay, so if we look at a blank worksheet here, we're going to see the steps for preparing the blank worksheet are to write the heading, record the trial balance, total debits and credits, record the adjusting entries, prove the adjustments column, and then extend out now to the balance sheet columns and the income statement columns, which we'll learn about next. Okay. In the meantime, so this is going to walk you through it. This is what your little plastic sheets do on your in your textbook. So if you take your little plastic sheets in your textbook, you can see the layering of them. Okay? So if you flip, you'll see that if you put down the first column, the first plastic page, you'll see that you just had the trial balance. Then you'll see the adjustments. Then we're going to extend out the information, and we're going to extend our balance sheet accounts into the balance sheet columns, and we're going to extend our income statement accounts into our income statement columns. Now, some of you might be saying, well, which is which? Okay? All of your assets, liabilities, and owner's equity are your balance sheet accounts. I can't draw on this thing. Oh, it is. Oh, hey, today it's working. Today it likes us. Okay. So these are your balance sheet accounts. So put balance sheet accounts here. These are your income statement accounts.
Wait, does it start at sales?
Sales through expenses are your income statement accounts.
So then balance sheet.
And their balance sheet accounts are all the ones above that.
Alright. So balance doesn't include sales, so it's like in the middle, I can't tell.
No. Balance sheet accounts do not include.
Oh,
Look here.
Right.
Look here in the columns, okay? So if you do this, this is what I would do. Mine's not it's because it's not paginating correctly or aligned correctly on here. Do this. Draw an X through all the balance sheet accounts in the income statement column. Nothing should go up here. Never put anything up here. Okay? Down here, on the balance sheet columns, there should never be anything down here. This is the balance sheet columns. Okay? So this is the income statement columns. This is the balance sheet columns. Don't put income statement accounts in the balance sheet. You don't put balance sheet accounts in the income statement. Okay? What's your question, George?
Are sales in the balance sheet?
No, I know. It's not paginating correctly. It's not paginating correctly, this thing, or whatever you call it. It's still not. Your sales down are your income statement accounts. Sales down are income statement accounts. See how they're in the income statement column? They're in these two columns for the income statement. So your sales down is your income statement accounts. All your balance sheet accounts are your assets, your liabilities, and your owner's equity. Write that down. Assets, liabilities, and owner's equity are your balance sheet accounts. Sales and expenses are your income statement accounts. Okay? And then again, you do a single rule, and then you total each column. Okay? Now, what do you notice when you total your income statement and your balance sheet columns? They're not equal. Very good. Very, very good. So, if you were a business owner, why do you think your sales might be different than your expenses? What do you hope that is?
If your sales are positive, then
Your net income. You're hoping that's your net income or your profit. Okay? If your sales are greater, the total of your sales, which in this case it's 3,565, if the total of your sales is greater than the total of your expenses, what do you think you have? If your sales are greater than your expenses, what do you think you have? You have a net gain, a net profit, a net income, okay? And what we've got to do is we've got to reflect that we've got that net income and how it positively affects the different accounts or the different financial statements. So now we've got that total. We've got a net income. We have to do something with that. We're going to put that net income, reflect the difference between these two by putting the difference. When we have a net income, we're going to add it to the debits column, and we're going to add it to the credits column under the balance sheet, because ultimately it's going to have a positive impact on our owner's equity. Remember that when we did that back when we were dealing with Chapter 1, we said that you want to have a sales greater than your expenses. Your sales have a credit balance. Remember we did that with their T accounts and everything, and we said sales has a positive impact on our owner's equity. So we want our sales to be greater than our expenses. Expenses have a negative impact on our owner's equity. Okay? So if we've got a net profit, meaning sales are greater than expenses, if we've got a net profit, then we're going to put a credit over here in our balance sheet to show that we've got a net profit. And then we bring the balances down again to make these columns equal. And then we'll double rule. Okay? Now that's where we end up. Okay? This is just explaining how we extend out the balances. This is literally taking each balance and bringing it over. Now when we work with our supplies account, look what happens. We've started with a debit in our supplies in the trial balance column. We've got a credit in the adjustments. So what do we do when we have a debit and a credit? We subtract, right? And we bring that balance over, and it's going to be in the debit column. Debit, credit, and then we have a debit. Okay? We have prepaid insurance. We're doing the same thing. We had a debit balance of $1,200. We have a credit of $100. Bring the balance over. In the balance sheet, it's going to be $1,100. These, there are no adjustments for, so the balances just come over from the same as from the trial balance. The same with our liabilities. We don't have any adjustments for them, so they come over into the credit column. Okay? All of our debits extend over into our debits column minus any adjustments. Okay? Now, so the balance sheet financial statement it reports the assets, liabilities, and owner's equity as of a specific date. And we'll learn about preparing the balance sheet in Chapter 7. Okay. Now let's extend over our income statement accounts. Okay?
I didn't get it.
Do you guys, did anybody else not get it? It's not going backwards. Oh, there it is. All right. It's just going to report our assets, liabilities, and owner's equity as of a specific date. Okay? Good?
Yeah.
Thanks. All right. Income statement. Just going to put everything up there. Income statement is going to be recording our revenues and expenses for a fiscal period. So again, we're dealing with the month ended August 31st. And we're extending over our sales balance. We're extending over our expenses balance. Now, we didn't have any expenses in our insurance expense in our trial balance, but we now have an expense in our adjustments column. If we had zero balance here and we had a debit of 100, what's our balance going to be, Ryan? And we had zero in our insurance expense. If we had zero in our insurance expense in our trial balance and we had a debit to our insurance expense in our adjustments column, what's going to be the balance of our insurance expense in our income statement? Is there a difference that we're taking, or are we adding it? We're adding it, okay? Because there is zero here, so the balance is zero. What's the normal side balance for our expenses? Debit, right, debit. So if we have zero and where normal balance is debit, we're adding to it, okay? So it's going to be 0 plus 100 equals 100, okay? All the rest of them, there's no adjustment. They're just bringing the balance over. Same thing with our supplies. We had a zero balance here. We had a debit of 715, so we're going to bring that over. So it's like 0 plus 715 equals 715. If I had supplies expense already, okay, let's say I had supplies expense of 200 here, what would be my balance in my income statement? If my balance was 200 in my trial balance, in my supplies expense, and I had an adjustment of 715, what would be my balance in my income statement? 915. Okay, so you're going to take what's in the debit column. If there's a debit in your adjustments, you're adding to it. Okay, if there was a credit here, which you won't ever have, you would subtract. Okay, it's just your normal balance side, whatever your normal balance side. If you're adding, if your normal balance side is a debit and you have a debit adjustment, then you're adding. If your normal balance side is a credit and you have a debit balance, you're subtracting. Okay, it's the same principles apply. Okay, and then we record our profits, single rule, record and extend, okay, your totals, and double rule. Okay, those are all the steps. If you had a net loss, this is how it would look differently. Okay, pay attention to this. Oops, my bad. If you had a net loss, now what happens here? This is where my debits on my income statement are greater than my credits, meaning my expenses are greater than my my sales. So I've got a loss of $400. So now I'm going to add that on this side in this column, and I'm going to add that on the debit side in the balance sheet column. And your problem, I believe, in your application problem has a loss. So you should make sure you know this, but you have it in your notes. Okay. Look at your work together. Let's go to our work together.